Have you ever heard someone say, "I'm investing in stocks," or "the stock market is going up or down," and wondered, what does that even mean? Well, don't worry. Today, I'm going to explain what stocks are, how they work, and why they matter, in the simplest way possible. Section 1. What is a stock? A stock is simply a piece of ownership in a company. Imagine your friend John owns a bakery in your neighborhood. It's doing well, and he wants to open a second branch. But he needs money to make it happen. So John decides to divide his bakery into 1,000 shares, each one representing a small piece of ownership in the business. He offers to sell some of those shares to raise money. You decide to buy 10 shares. That means you now own 10 out of 1,000 shares, or 1% of the bakery. You're not baking bread, but you are now a part owner. If John's bakery grows and makes more money, the value of your shares can increase. He might even decide to share some of the profits with you. Those are called dividends. So even though you're not running the shop, your money is working for you, and that's the power of owning stock. Section 2. Stock, share and stock exchange. A stock is the general term for ownership in a company. A share is one unit of that ownership. The stock exchange is the marketplace where stocks are bought and sold, like the New York Stock Exchange, London Stock Exchange, or the Nigerian Stock Exchange. Think of it like Amazon, but instead of shopping for clothes, you're shopping for company ownership. Section 3. Why do people invest in stocks? Well, here are 3 big reasons. 1. To grow their money. Stocks can increase in value over time. In 2010, one share of Apple AAPL cost around $30, adjusted for splits. By 2020, that same share was worth over $130. That's more than 4 times the original value in just 10 years, not including dividends. An investor who bought and held Apple stock during that time saw their money grow steadily, simply by staying invested in a strong company. 2. To earn dividends. Some companies pay you a part of their profits, just for holding their stock. Suppose you own 100 shares of Coca-Cola. Coca-Cola pays a dividend of about 46 cents per share every quarter. That means you'd receive around $184 per year, just for holding the stock, even if the price doesn't change. Over time, you can reinvest those dividends to buy more shares and grow your income, a strategy known as dividend reinvestment. Dividend-paying stocks can provide regular income and help build wealth, especially when reinvested consistently. 3. To beat inflation. Keeping money in the bank might not grow much, but stocks have the potential to grow faster than inflation. Basically, people invest in stocks to build wealth over time. Imagine you kept $100,000 in a savings account earning 2% interest per year, while inflation is rising at 15%. After 1 year, your money grows to $102,000, but what you can buy with it has shrunk in value due to inflation. Now compare that to investing the same $100,000 in a stock index that grows at an average of 12% per year. After 1 year, you'd have $112,000, keeping you closer to, or even ahead of, inflation. The stock market goes up and down. That's called fluctuation, and it's totally normal. Sometimes a company does well, and its stock goes up. Other times, things like bad news, economic changes, or global events make stock prices drop. That's the risk of investing. You can make money, but you can also lose money. But here's the key. If you invest smartly and think long-term, the stock market has historically gone up over time. Section 4. Advice for beginners. So if you're just getting started, here's my simple advice. 1. Start small. Even a few dollars is enough to begin. You don't need to be rich to start investing. Imagine you have just $50 saved up. Instead of spending it all, you decide to invest in a low-cost index fund. You might only afford 1 or 2 shares at first, but that's okay. What matters is getting started, learning how the market works, and slowly building your investment over time. Think of it like planting a seed. It may start small, but if you stay consistent, that tiny investment can grow into something big. Even with just a few $1,000s, you're taking the first step to building wealth, and that's powerful. 2. Learn before you invest. Understand the company or fund before putting your money in. Let's say your friend tells you about a new company called Quickrich Tech. He says, everyone's buying it, you should too. But you don't know what the company does, how it makes money, or if it's even profitable. If you invest blindly, you're basically gambling with your money. Now imagine instead, you take time to research a company like Apple or Tesla, or a trusted mutual fund. You look at what they sell, how long they've been in business, their financial health, and how they've performed over time. By doing that, you're making a smart, informed decision, not just following hype. Bottom line? Don't just invest because someone else is doing it. Know what you're investing in, and why. That's how confident investors are made. 3. Think long-term, don't panic if prices go down today. Think in years, not days. Let's say you buy shares of a strong company like Amazon or Microsoft. A week later, the price drops. You panic and think, I'm losing money. But here's the truth. The market goes up and down all the time, just like the weather. Imagine planting a mango tree. You don't dig it up after 1 week just because it hasn't grown fruit yet, right? You wait, water it, and stay patient, because you know the real value comes over time. It's the same with investing. The most successful investors hold their investments for years, not days. They stay calm during dips and focus on the bigger picture. So when prices drop, don't panic, think long-term. That's how wealth is truly built. 4. Diversify. Don't invest in only one company. Spread your risk across different sectors or use index funds. Imagine you have all your money invested in just one company, let's say a tech company. If that company faces problems, like a drop in sales or bad news, the value of your investment could fall a lot, and you might lose money. But what if you spread your money across different businesses? For example, you buy shares in a tech company, a bank, a telecom company, and even some consumer goods. If one company or sector has a tough time, the others might still do well, balancing out your risk. Another easy way to diversify is by investing in an index fund, which is like buying a small piece of hundreds of companies at once. So, diversification is like not putting all your eggs in one basket. It helps protect your investment from big losses. 5. Avoid the hype. Just because everyone is buying a stock doesn't mean you should too. Do your own research. Section 5. Quick recap. A stock is just a piece of a company. When you buy one, you become a part owner. Stocks go up, they go down, but if you stay smart, stay patient, and keep learning, you can build real wealth over time. If this video helped you, make sure to give it a thumbs up, drop a comment, and hit that subscribe button for more simple money tips. Thanks so much for watching, and remember, you don't need to be rich to start investing. You just need to start.